Good evening, ladies and gentlemen, and welcome to this special event here at Georgetown University, with the support of the Global Policy Institute, a think tank affiliated with the university. My name is Paolo Fonschirach. I serve as president of the Global Policy Institute, and I've also been teaching at the Bay Atlantic University for now 10 years, I guess, something like that. So welcome to everybody. And it is with special pleasure that I make a quick introduction, I promise. And I would like to thank Professor Bintu Ngani, who's the chair of the business department of the university, and of course the professor who's actually organized this thing. And we are here just in support role, and to his special guest who will talk about nothing very light, I understand, just the global macroeconomics. Very easy. Talk, quick subject.
We'll see.
So, I'm sure everybody's looking forward to his comments, and the professor will moderate the event. Again, we are having this special lecture since everybody's also connected via Zoom. So it's available to outsiders, to friends of GPI and the university, people who can join us virtually from wherever they are, and everybody, of course, is welcome. And so without further ado, I would like to have the professor here, who is actually hosting and moderating, introduce the guest.
Great, thank you.
Okay, Paolo. Good evening, everyone. Welcome to our seminar titled Global Macroeconomic Outlook and Markets. I'm Eşref Mehmet Göksu. I'm adjunct faculty member at Economics Department. I will be your moderator today. It's my pleasure to introduce our distinguished speaker, Eylem Senyuz. Eylem Senyuz is a senior vice president and senior global macro strategist at Truist Advisory Services. He is responsible for analyzing the global economies and financial markets, as well as helping formulate and communicate investment strategy. Eylem helps develop strategy and tactical asset allocation strategies, driving the management of private and institutional clients. Eylem is also an adjunct faculty member at Georgetown University, where he teaches a graduate level finance course covering investments in emerging markets. His areas of focus are global macroeconomic outlook, geopolitics, emerging markets, global equity and fixed income markets, asset allocation, and portfolio construction. His insights are also shaped by nearly 2 decades of experiences across firms like Rowe Price, Ashmore Equities, Charles River. Please join me in welcoming Eylem Senyuz.
Thank you.
Eylem, thank you very much for being here. These are really extraordinary times, historic in many ways.
I guess a question is coming.
Yeah.
Before the question, can I do this? Can I ask 2 questions to the audience? Sure. And let me introduce myself as well. Thank you for the introduction. As you see, I have a very boring job. I'm Eylem Senyuz, or Eylem Senyuz for the Turkish people, who speak, Turkish. And my parents were visionaries. I have this very unique name. There's only one Eylem Senyuz on the planet. I'm the only one. So if you're looking for me, if you're Googling me, if you're looking for me on, LinkedIn or TikTok or whatever, you use, you can find me very easily. And you can ask ChatGPT, who's Eylem Senyuz. ChatGPT will tell you. It will tell you that I work for the Truist Bank. I'm global macro strategist for the bank. I also work for the Georgetown University. I teach, courses there. It's great. It's great to be unique. And I always ask 2 questions to my students on the very first day that I meet. I'm going to ask that same question to you as well. So 2 questions, and I'm going to answer related to the answers that I'm going to get it from you. The very first question is: imagine you're graduating today, you start getting a job, and then you start saving for your savings accounts. Let's say 401ks, IRAs, and stuff like that. What is your expected return for your portfolios for the next 40 years on average, a percentage number. What would you say to that question? Is it 1%? Is it 2%? Is it 3%? Is it 10%? Is it 20%? I asked this at the university as well, and don't worry, and my students are clueless when they're answering this question. And
8 or 9%.
Yeah, 8 or 9%. 8% shows up every time I ask this question. So imagine that's your average answer as well, right? But when you look at the average returns of S&P 500, which is the kind of the simplest way to invest into the stock market, for the last 40 years, let's imagine, today is, 1985, October 21st, and then you're investing, for the next 40 years, what is the expected return of S&P 500? It's 12%. 12% on average every year. That's unbelievable. That's the first question. The second question that I ask is imagine you're saving $5 a day, every day in an account, and you invest to S&P 500. So every day you wake up, you put $5 into an account, and you buy S&P 500. You do this over and over again for 40 years. How much money would you have today in your account? So the simple math is 365 times 40 times 5, that's the amount. Let's say $72,000. So $72,000 goes into the market. What would you have today in the a lot? $1.5 million. $1.5 million. Then the question that I have to my students is why don't you do it? Why don't you do it? Open an account, put $5 every day, day after day, for the next 40 years. So let's start with that. So trying to remember that 8% answer, because that's the answer that I always get from my students. But the real answer is 12% return, right? And then can you get that return from the market? Meaning you have to open an account, you have to invest into it, and then get that 12%. And my job every day is to find that 12%. So my easiest answer, my basic answer is okay, go to S&P 500, invest into it, or you have to take some risk in some overseas markets. I manage portfolios investing into emerging markets. So I've been to Colombia, I've been to Peru, I've been to Saudi Arabia, or Morocco, or there was a lady from, you were from Ghana, right? So I've been there as well. So we were getting into these countries trying to find returns higher than 12%. So anything and everything you do, it needs to be benchmarked. That benchmark is 12%. Keep that in mind. So if you have a brilliant idea, people will ask okay, is your brilliant idea is better than the S&P 500? If it's not, then you don't have a brilliant idea. So I'll try to answer all the questions related to these two answers. 12% return goes into the market, but then you have to invest into it as well. So let's start with that. How about that?
Great.
Sounds good. Perfect.
And try to avoid investing before global financial crisis or dot-com crash. We will see.
Actually, those are the best days. If there is blood on the street, those are the best days to invest into the market. You go back, the recent one is, of course, the COVID period. If you remember, the stock market went down 35% that year. But you go back 2020. Anyone remembers the closed return of S&P 500 of that year? Was it positive or negative in 2020? Was the stock market up or down? It closed up. So at one point in time, it was down 35%. It's closed up maybe 15% up. So from the bottom till that end day, you made up almost 50% return. That's unbelievable. So try to remember that as well. Trying to get into the market when everything is down. Yes.
Yeah. If you invest those $5 in those times, it would be much better. Right?
Those are the days you need to invest $10. If you go to a shop and let's say the t-shirts are 30% off, what do? You buy two, right? So get one free type of stuff. That happens in the market. So do that.
So these are also truly extraordinary times. So to begin, could you walk us through your view of the current macroeconomic environment? Where do we stand today, and where do you think we are headed from here?
Sure. Let me give you a bigger picture coming out of the IMF data set. IMF comes out every quarter. They have this data set. They publish 4 times a year. They just published it last week. So there is 3.1% GDP growth rate out of the world. But when you look at the 3 buckets that we study, there are different stories. Of course, the most important economy on the planet is the US. So roughly $30 trillion is in the US, 105 trillion in global markets. Let's say 26, 27% is in the US. And then we have the European markets. I'm including all the European countries, the 27 EU plus the UK. They got divorced, but they still want to be in the EU. So 28 countries, including Switzerland, because I would say they're in the part of the EU story. And there are some countries they want to be in the EU, like Ukraine, Turkey, and ex-Yugoslavian countries. I include those as well. I include your country, Russia, into that too. So they have the same amount of GDP like we do in the US. 27% of the world's GDP is in the European bubble. And then we have the Asian economies, which is the most exciting part of the world. I would include, India and all the countries around it. Pakistan, Bangladesh is in there. And then China, and then Southeast Asian countries, Philippines, Malaysia, Thailand, Indonesia, they all included in that. They also have 27% of the world's GDP. So this is the first time in world history we have three buckets. They have the exact same amount of money, right? And when you look at the Asian growth rates, of course, 1.4 billion Chinese, 20% of entire humanity is Chinese. That's unbelievable, isn't it? And then we have India, another 20% of entire humanity is Indian. That's unbelievable. That's great, actually, for the people who live in the US. The reason why is if you have a fear of alien abduction, and if you're living in the US, so imagine an alien ship comes to our planet and wants to grab one person from the society. It's not going to be an American, don't worry. So it will be either a Chinese or an Indian, because statistically speaking, there's lots of people living in those areas, right? And they're growing amazingly. India is growing almost 7% a year, every year for the next 30 years, 30. So if an economy is growing 7% a year, in 10 years it doubles. So we're expecting India to double, and then double again, and then double again over the next 30 years. That's unbelievable, right? And at the end of the century, 2100, and if someone asks which economy will be the largest economy on the planet, I would say India is candidate number 1, and then US number 2, and then China number 3. So it's in that order. And China has a huge population problem. So right now, 1.4 billion people. Guess how many people will be living in China based on the UN data at the end of the century? So today, 1.4 billion. At the end of the century, guess how many people would be living in China? 700 million. So they will be losing 700 million people over the next 75 years. Almost 10 million people per year, year after year, they're losing. Right? The population is going down. What is 10 million? That's like the size of Greece every year for the next 75 years, every year. Right? And when you look at the Chinese map, they have the East Coast, but they don't have the West Coast. Right? Everybody lives on the East Coast. And if you draw a line from Beijing to Shanghai, Shenzhen to Hong Kong, 80% of the people will live on the right-hand side, and only 20% lives on the left. Right? They have all these apartments, very cramped, locations that they live, and their population is coming down. That means their real estate values will come down, and most of their savings are in the real estate, so they will lose significant amount of money. But that doesn't change the fact that all the countries that are in India and around India, they will grow much faster than the Southeast Asian economies. When you average them out, we're expecting like 4% growth rate for the next 10, 15 years, maybe 20 years, other than the India growing 7%. Europeans, when you do the same analysis, their population is going down. There's a war going on in the middle of Europe that's not, helping the data set. At best, they will grow 0.5% on average for the next 10 years. But when you look at the US, which is the most important economy, because we have 50 states, everything is connected. You have labor mobility, you have one central bank, one monetary system and fiscal system, and one army. It's growing, I would say 2.5% over the next 10 years. When you ask that same question to CBO or OECD or IMF or Federal Reserve, they will tell you 1.8%. So we're expecting that US economy will do much better than a lot of people are anticipating. And the data is backing that. If you go back 10 years, 20 years, the average growth rate is 2.4. So 2.4, 2.5 is doable, possible, especially with the artificial intelligence, helping certain things in the US. And also energy production is coming back, industrial production is coming back. So there's some good stories coming out of US, other than demographics in the US as well. And demographics, not like, hey, there are not many, enough babies, or the natural growth rate of the population is not positive. It's not the problem. The problem is, there's a deportation going on, right? And there's this H-1B problems that you have heard about it. 730,000 people got affected by that. So this year would be, or could be, the very first year that the US population is coming down. Since this is the first time since 1980. May happen this year, may happen next year, so we don't know. But still, with that, US is growing this year 2%, maybe over the next 10 years, easily 10%. Europe is 0.5%, and Asia, I would say 4.5%, but most of that growth is coming from India. So if you're looking for opportunities for investments, so you have to have a high growth rate, right? So where is that high growth rate? It's in Asia. But then the question is like, can you invest into Asia easily? There's the big economies, China, but then China economy is complicated because it's not controlled by private enterprises, it's controlled by the government. So the government will allow you to make money in the economy or not is the big question. Versus you have India, still a significant portion of the Indian economy is controlled by the government, but there's some private enterprises you can invest, especially small cap companies. And super smart people living in India, and they're producing amazing stuff, and they're very competitive as well. So it's an interesting market to look at. But still, in the US, if you have S&P 500, generating 12% returns, and within S&P 500, you have amazing companies like Nvidia's, Microsoft's, and Amazon's, and Google's, and stuff like that. It's really difficult to compete with them. And an index like S&P 500 is a living beast, meaning SpaceX is not in there right now, right? ChatGPT is not in there, OpenAI or Perplexity. Yeah. Or there's like another company on the AI space. Canva is not in there. So eventually all these companies will have an IPO and they will get into the S&P 500 index. And the smallest S&P 500 entity or the entity that got merged in to some other companies will disappear, and you will have new companies to invest. It's a unique way of investing into the markets, basically. I hope that answers your question. It's a long question, but
it's 50 years, 100 years.
Yes, exactly.
So let's go back to more short-term issues, maybe. So I want to talk about today's economic outlook, macroeconomic outlook, and especially I want to talk about Federal Reserve policies. So there are some concerns in the labor market, which you just mentioned, and there are some indicators that labor market is weakening, like payroll gains has been a little bit lower than it used to be. But on the other side, the headline figures are still strong. We still have unemployment rate at 4.4 percentage point levels, and also the growth figures are strong, like
in the US,
consumer consumption, and also AI-related spending is still
huge,
at high levels. So do we need to? And on the other side, inflation is still above the target rates. The core PC is close to 3%, and but under these conditions, do you still think that the policy rate is restrictive and needs to be reduced to ease the financial conditions? Because that's the main argument from the administration, and it is a kind of pressure on the Federal Reserve for the decisions.
Yeah. So the question is, we have currently the interest rates little lower than the 4%. Are we, are they restrictive enough to make sure that the economy cools down? If you're studying the US economy, there are 4 data points that you have to know in detail. And out of 4, I would say one of them is insanely important. How many people are receiving paychecks in the US? That's the question you should be asking. So if you go back to before COVID, we had 152 million people receiving paychecks. And we got hit by the COVID, right? How many people lost their jobs? Do you remember? Out of 152 million people, 22 million people lost their jobs. So we went down from 152 to 130. We slowly recovered everything. So we went back to 152. The last number is 156 million. So we added 4 more million people working in the US, receiving paychecks. And it's the highest number ever, historically. Okay? And then the next question is like, okay, everyone is working, 156 million people, but are their paychecks higher than the inflation number that you've mentioned? So when you look at the wages are growing a little bit like, 4.2%, definitely higher than the inflation. And this has been happening for the last 2-3 years. So you have good amount of people working, their paychecks are really high. And when you look at their income is good. So personal income is great. And then that creates personal consumption. Consumption is amazing in the US, and that creates production. So when you look at these numbers, as long as we create new jobs, as long as that pays you a good amount of salaries, and that turns into an income, that turns into a consumption, you're okay. And the biggest question is, okay, the interest rates are still too high, I believe, and especially when you have $37 trillion debt in the US, someone is paying interest rate on it. Should we pay, let's say, on average 4% interest rates on that debt? If you ask my personal opinion, no. What should be the number? I would say the average inflation rate. The average inflation rate over the last maybe 10, 20 years, it's 2.5%. So the US government can say like, okay, we're paying 4%, we don't have to do it. We can bring it down to 2.5%. Will people still buy our treasuries? My answer is yes. Because you don't want to buy Japanese treasuries because they're giving you maybe a percent and a half. You really don't want to do the same thing in the European context. They're paying you maybe a percent and a half. Would you like to buy RMB bonds in China? It's debatable depending on which country you're from. US dollar is still the king in the market, and people will be able to or will be forced to buy bonds of the US even though the interest rates are low. For that to happen, inflation needs to come down. And the biggest positive thing that we see is I don't know if you noticed, the energy prices are down, one of the lowest periods that we have. And OPEC introduced new, production in oil. So that means the entire energy complex is going to come down. And that's the biggest piece in consumer price index. The second biggest thing is apartments. If there is this many deportations in the US, if people with the H-1Bs are leaving the country, the question is, where do they live? They live in apartments. So if the moment they, move out, that means the rents in the US will come down, right? And that will get translated into CPI numbers. That, allows the US to bring down the interest rates. The moment interest rates goes down, the mortgage market becomes open. Right now, it's locked. If you have a house, let's say around this, DC, I would assume that you're paying maybe maximum 3%, maybe 3.5%, because you bought your house a couple of years ago and then you locked it in, and you don't want to sell. Why? Because the moment you sell and buy another house, you're going to pay 7% mortgages. No one wants to do that. But the mortgages comes down to, let's say, 5.5%, maybe 5%, and people will say, okay, I'm going to sell my house and then buy a new one and renovate that one. Right? And every time you buy a new house, you have to renovate it because you're not going to like the kitchen, you're not going to like the bathroom, and then you're going to create some economic activity in that new house that you purchased. That will create enormous amount of activity in the US going forward for the next couple of years. I hope that answers your question.
Yeah. Thank you. Just a follow-up question about the average wage increases. Is there a divergence between the increases? Because some people liken to the K-shaped recovery, and some of the jobs at the upper income levels are paying more, but the lower levels they're paying much less. So that these are the people who are negatively, severely affected by the rise in inflation.
You're right, but at the same time, now we have this. It's hard to define that, but it's like an Uber or DoorDash economy. So let's say you don't have a job or you need a second job. What's the easiest way for you to get an income is you work for these type of companies. That creates some benefit to the society, of course, for sure, that that keeps the employment in check. Not only that brings some extra income so that you can spend on it. Of course, we didn't have that 10 years ago or 15 years ago. So when you're comparing data today versus 20 years ago or today versus 15 years ago, it gets complicated. So we try to kind of fudge the numbers in a way that looks a little bit better than what it used to be. That's the number one. The other thing is like a good amount of the US, especially the ultra high net worth group of people, they're already invested into the market. What did they buy? Maybe 10 years ago, maybe 20 years ago, they bought Microsoft, they bought Apple, Nvidia, and they're all up. right? They're up like almost like 1,000%. And of course they feel, more wealthy. They don't even have to work. And then they can just, sell their assets and then continue with that lifestyle, without working. Some people are choosing to do that. If you look at the labor participation in the US, again, before COVID, 63%. Today, it's 61%. That means out of 100 people that can work in the society, only 61 of them are working. And it used to be 63. So we have 2 more people that are not working, but somehow, so they can get away with it. So maybe all these policy changes in the US, because if you're not working, you're losing your healthcare coverage. That means you have to go back to the workforce, or inflation is too high. That means you have to find a job and, make sure that you can spend as much as you want. That's great. So those 2 extra people that are in the society, we're trying to convince them to come back to the workforce. And it looks like slowly, very slowly it's happening. So if you add those numbers into the kind of projections, yes, the US economy can definitely grow 2% for the next 10 years, unless something crazy happens.
So I want to expand that the status of the dollar, because you expressed your trust in the future of dollar.
Yes.
So it has been at the center of the international monetary system since Second World War and after the Bretton Woods. And even during the financial crisis, which originated in US, people just bought more dollars because it was always been, it's an insurance, right? But do you think dynamics are shifting a little bit when we look at these gold prices and other things? And when you consider the pressure on the Fed and the debate about the independence of the Fed, do you think that is a threat on the reserve status of the dollar in the future?
It is, but around the edges. I mean, dollar is still the king, and it's hard to find an investable asset that has the liquidity that you need and also provides you opportunities for you to buy. So if you have dollar, that means you can buy Microsoft. That means you can buy US treasuries or corporate bonds. You can, make money out of money as well. If you're investing into gold, doesn't give you dividends, and it's really difficult to barter with gold as well, unless you are a country that buys oil and gives gold and do a barter system with gold. There are some countries trying to do that, and there's some, especially in African context. This week we had a news out of Ethiopia. They were exchanging some portion of their dollar debt into a renminbi debt. So they're saying like, I have $5 billion, let's say, bonds that I owe, and China is giving them, let's say, $1 billion or $2 billion, and then they're paying back the previous bondholders. Now they have a renminbi debt instead of a US dollar debt. And if that continues for a long, long time, let's say another 30 years, 40 years, yes, we may see maybe 20%, 30% of the world's reserves stored in renminbi instead of US dollar or gold. Slowly it's happening, but we're at the very beginning of it. When you look at the renminbi reserves, it's like less than 3%. If you include, Canadian dollar and Australian dollar reserves, it's higher than the renminbi reserves, right? No one is talking about, Canada taking over the world or, Australia taking over the world. It's happening, but very slowly. It's not quickly. The biggest competitor to US dollar is euro. If you're, close to a European country, yes, euro is a means of, store of value. You can, travel in many European countries and you use that currency, and you do a lot of, business activities, related to euro, and you can borrow in euros as well. There's good amount of banks that are giving you credit in euro. That's great. I would say, euro has a higher advantage versus the renminbi than many other currencies, including gold as well.
What about Chinese yuan?
Yeah, I mentioned it. Renminbi is getting up there, but it's less than 3% right now. And when you include the Canadian dollar and the Australian dollar, it's even higher than the renminbi right now in terms of reserves. In order to become a reserve asset, you have to give good amount of opportunities to buy with that asset. You either buy treasuries, meaning Chinese treasuries, right? Or you buy Chinese corporates, Chinese bank assets or equities, which is not that easy if you're a foreigner. Now they're opening up their market so that foreigners can easily buy certain assets, but still it's not compared to the US or compared to the European markets. But in 20 years, of course, there will be some changes.
But maybe these types are a little bit motivation for the Europe to have single market, more deep markets, and
they're working on it. They're even trying to create a single way of trading stocks in 24 hours, 7 days. So there's a good custody system in Luxembourg, in Belgium, in Ireland. So they have amazing banks, very competitive banks versus the US, and they create credit. You need to create credit in the system so that people can borrow in euros or some other currencies that they provide. It works well, but at the same time, we thought that by now there will be a couple of the big countries joining into the euro, like UK was one candidate, and then they divorced. And how many countries we got added, one or two into the euro list over the last 4 or 5 years. Maybe
under these conditions still
maybe Ukraine will be included into European Union, and they will have euros, and maybe Turkey one day will be part of the European Union. They will have euros as well. Possible.
Yeah, it's still the main trading currency, main invoice currency.
You're right.
But do you really have concerns about these attacks on the Federal Reserve?
We do. Of course, we want to see independent Federal Reserve, independent, central banking system. That's for sure. There's so many papers written about it, and IMF is here. If you search IMF's database, there's like at least 200, papers written about that. UK Central Bank, Bank of England, had a lot of research, and it's the oldest central bank in the world. They have, I think, they celebrated 300th year a couple of years ago. They're saying like, hey, look, we need to stay independent. But I can understand at the same time, politics gets involved with it a little bit here and there around the edges. But this time a little bit more than usual on average. But I believe, the US will continue with that independence. I don't think there will be major changes in the central banking in the US. There's so many players that are kind of protecting that system. I don't think it will be easy to break that.
Maybe continue to reducing the interest rates despite the rise on inflation would be a bad indicator in the months ahead, because it should just affect the long end of the yield curve, and it would
everybody talks about that. The question is like, hey, inflation is high and everything is kind of expensive in terms of asset prices. Equities are at all-time highs, and the bond spreads are all-time low. So why are you reducing the interest rates, right? That will fuel the bubble that is in the market. Yes, there is a risk to that, but at the same time, when you look at the labor data, they had that adjustment of almost like 900,000 people that they estimated wasn't even there. So because of that, it's okay, I would say, to cut the interest rates. And not only that, the inflation is coming down, like I mentioned. The energy prices are coming down significantly. So it's not happening instantaneously, but of course, what you see in the spot market will have an effect in 3 to 6 months. So we'll see that. And the rents in the US, they will come down. If you're deporting this many people out of the country, so you will have empty apartments. So it's the same problem that China is going through, right? And there will be a price effect in the US.
With the reduction in the federal government, DC will be affected.
Yeah. But the reduction of the federal government, they're still in the US, right? They're not moving out of the country. Or
some metropolitan areas will be more.
If there are some US, citizens there, they want to live in Canada or in Mexico or in Europe, and I'm sure there is some people moving to other countries. Yeah, fewer people living in the country, that brings down the prices.
So Eylem, you must have already been struggling with lots of uncertainties that we talked, and geopolitical uncertainties, policy uncertainties, tariff rates, everything change. But another dimension is added with data uncertainty. Because of the government shutdown, you do not have access to labor data, inflation data, futures market data, the positions, right? A lot of things. So how do you manage all these uncertainties?
I mean, we have some alternative data. There's, I mean, we use Bloomberg Terminal. Thank God, Bloomberg Terminal, allowed us to look at some other private data sets that we can say, okay, I don't have the labor data, but can I look at some other data points like ADP is, one service provider that, we look at. There's some other price indices that we can look into it as well. And plus, US is not the only country on the planet, right? We have, almost 160 countries that we get data. So we can kind of estimate what the US will look like, especially in the inflation versus what other countries are doing. If the entire world is, inflation is going higher, that means US is going higher as well, most likely. So we can, make some adjustments there. But the good thing is, hopefully before Thanksgiving, the US government will be open. It looks like they're working on the CPI data. CPI will come out next week before the FOMC meeting. FOMC meeting is going to happen, I believe, October 28th and 29th. So it's not a big deal, to be honest with you. If this continues, of course, 6 months, that's a big deal. But it looks like, we'll have a solution before the Thanksgiving.
Hopefully.
Yeah.
I have some friends who furloughed. So,
Yeah. Of course, in this city, this is the most important part of the town.
Someone from the street, from the
exactly, yeah.
So actually, we talked about this a little bit, but I want to expand it a little bit further. So US markets have been outstanding in the last decades, right? They have performed much, much better than the rest of the world.
Correct.
Everyone is investing in US markets because market cap is amazing. But in the recent months, there has been some discussions about if it is the right time to diversify away a little bit from US to the other parts of the world, like Europe, maybe Asia. Do you still believe in the US exceptionalism, or is it time to think about the portfolio allocations a little bit more in a different way?
In the long run, yes, we do believe in US exceptions. The reason for that is there are 3 I's that US offers that not every country can offer. The first one is the institutions, the independent central bank, maybe some independent fiscal policy here and there, and then the legal system is unbelievable. Political system compared to a bunch of other countries is unbelievable, and we believe that's going to continue. So if you have a system like this, especially very strong institutions, that creates innovation. So innovation is happening here. Where is ChatGPT, innovated here, and all kinds of crazy chips that are kind of creating those LLM models, designed here, produced in Taiwan, but built here, right? So innovation happens here as well. And when I look at this room, I can definitely say that inclusion in this country is one of the best compared to a bunch of other countries on the planet. And I've traveled a lot. I lived in Germany. Living in Germany as a Turkish person, it's a difficult thing. I lived in the UK. I lived in France before moving into the US. I can definitely say that this is the most inclusive society that I've ever lived. So how many countries can say that? I would say Canada would be number 1, or Australia could be number 2, and UK is changing around the edges, but US is still at the top. As long as that continues, meaning the smartest people on the planet, like you, coming into the US, studying and staying in the US and working for the US, and eventually would be able to say, hey, I'm American, I can work for this, and then make things happen. Yes, and there's an exceptionalism coming from that. So institutions, that brings innovation, but the most important thing is inclusion. It's a very unique country versus all of the ones that I've been to.
And you believe that?
That will continue.
Yeah.
Yes, yeah.
Okay.
I mean, yes, there will be good days, bad days. Sometimes you have a good hair day, bad hair day. Especially now, sometimes you have a bad hair day, right? No one got my joke, but it's fine. Things will pass, right?
Another question, maybe, of course, AI related.
Yes.
I'm sure you must be tired of these questions, but AI related investments account for a huge portion of GDP growth, and AI related companies account for a huge portion of the S&P 500 market cap, and also the increase in the S&P 500 in all the indexes, right? So everyone now talks a little bit about, is this a bubble? Are we living times like .com crash before the, I mean, so do we need to worry about that?
We do have to worry about it. I mean, I remember in 1998 when I first came into the US. So I was investing into the market as well, and then we had a massive rally in 1999, and there were companies with no earnings. Forget about the income. So they had no earnings. They had like, okay, we were creating this new website, let's say pet.com. No earnings, no income, and the value of the company is like $2-3 billion. So we were like amazed. What happened to those? 90% of them collapsed. And today, when you look at the market, they're like, I can give you 100, maybe 200 companies. No income, no earnings, just ideas. They're saying like, okay, we will build nuclear plants in the US. We have all these designs. We have all these amazing people working for us. And to get a permit to build a screened porch in the US takes 6 months. Forget about the nuclear reactor. Right? It will take like 4 or 5 years to get the design, and then another 4 or 5 years to get the permit, and then another 4 or 5 years to build it. And these companies, they're burning cash, right? And they're valued, I don't know, $20 billion, $15 billion. There are a lot of companies like that. So if there is money going into them and supporting them for another 10 years, yes, fine. That means there will be some cash flows coming back. But many of them will fail. It looks like it. But then there are companies that are producing already a bunch of other things like Microsoft, Apple, Nvidia, Google's and stuff like that. They're creating enormous positive cash flows, and they're allocating that cash flow to CapEx spending. And that CapEx spending will start paying them eventually. You already started doing that. I'm sure you're paying money to ChatGPT, or maybe you have some free versions, but eventually imagine you're paying, I don't know, $30, $40, $50 in certain agents that you're using, and you have 8 billion people doing that, and they will get the most benefit out of it. And this also, they have employees, so they can replace some portion of their employees with the AI tools that they generate, or they produce more stuff. And that creates high GDP growth rates. Now, imagine yourself 100 years ago as a farmer. So you're at your farm and you see the tractor for the first time in your life. You're like, oh my God, this is going to take my job, or I'm going to hop onto this and then I'm going to use it and then I'm going to make more money. So you have two options. You either get scared and don't do anything, you lose your job. Yes, that can happen. Or use it for your benefit. And I strongly recommend you to use all kinds of AI tools as much as possible on everything. Because if you don't use it, someone else will use it and it will do a much better job than you can.
If you're a labor on that land, or you're the owner of that land.
Right. But I've read an article and it was saying like, if your job doesn't require intelligence, artificial intelligence will not get your job. So you can find something like that, like a very basic job that doesn't require any intelligence. You're like, okay, I'm safe. I don't have to, worry about artificial intelligence. I guess, that's one option. The other option is like utilize it and use it as much as possible.
So do you really think that it will disrupt many industries?
It
will really transform everything?
Not everything, but many industries. And then we'll use it in a different way as well. And Daran Acemoğlu, I'm sure you know him. He's the Nobel Prize economist. He wrote an article. He's from MIT. He was saying like, okay, maybe 5 to 10% of the jobs will be immensely affected, but the other 90% will utilize it, but it still be there, but will utilize it and make it in a different way to basically, create some productivity in the society. So 90% safe, maybe 5 to 10%, we need to worry about. But those, 5 to 10% can be allocated to different works that doesn't exist today. We cannot even, think about what the type of, sectors that will show up. If you remember when you first got your iPhone, we didn't have Airbnb, we didn't have Uber in it, we didn't have a bunch of other applications. Now we have all of them. So in 10, 15 years, we've created brand new sectors in the society that didn't exist, 20 years ago. New stuff coming in, yeah, amazing.
So maybe we can stop here and open the discussion.
Q&As?
Yeah.
Yeah.
please join us. And if you have any questions, yes.
A couple of questions. Thank you very much for all the insights you shared. You referred to the interest rate and all the politics and things involved in that. What is the lowest rate that you would anticipate in 2026 throughout the year? Do you think that?
If I have to pick a number, it should be equal to the inflation rate. If the inflation is 2.5%, I would guess, the government will push it, to 2.5%.
So, but if it's a government rate is 2.5, it means the market rate remains about.
And another 3% on top of it.
5.5.
Yeah, 5.5.
Okay, and the other question is, you talked about the US national debt. So how much longer how many more years this country is going to remain?
Many more years. Many more years. When you get to $37 trillion, where is that $37 trillion debt? First of all, 8 trillion is in the central bank. So left pocket owes money to right pocket. Right? So you have to take that out. So that means it's not 37 trillion, first of all, it's less than that. The thing that you're looking at is the debt side of the balance sheet. Where is the assets? So US government doesn't have any assets, nothing, right? So you need to think about, okay, all the wealth that we have in the US, what is the total wealth the entire society has in the US? What's that amount? $200 trillion, right? If I introduce 1% wealth tax into the US, that's $2 trillion. Boom, I pay almost 10% of the debt. Can I do it? Of course I can. No one will elect me, right, if I say something. But then I create inflation. What is inflation? Inflation is basically a secretive way to grab a portion of your wealth without you knowing it or without you saying anything about it. So if I say 2% inflation, that means I'm grabbing 2% of your wealth every year. If I increase that to 3%, boom, I'm grabbing 1 more % from your wealth. Debt to GDP, the denominator is GDP. What is GDP? The nominal GDP, not the real one. So you have real growth plus the inflation, that's the nominal GDP. If I increase the nominal GDP, I'm increasing the denominator. So the debt to GDP will look smaller. And it's already happening almost this year because of the tariff revenue that was not included in any projections. The $200 billion that the US government collected, it was not included in any number on CBO projections. The big, beautiful bill, they calculated it. They said, like, okay, this is going to increase $4 trillion, but there is a tariff revenue. They're like, we don't know it. We don't know if it's going to be 100% or 10% or 5%. Today it's 5%, tomorrow it's 100%, and then goes back to 5%. I can agree with them, because it's really difficult to calculate, but there's real number coming in. There's a brand new tax that got introduced in the US without going through the Senate, without going through the Congress. Unbelievable. And it's massive. We used to pay like 2% on average. Now we're paying 9% on the imports that we're getting, outside of the US.
If I may, the third question is about going out into the local market in the US. You see like an overwhelmingly vast majority of items being produced outside. So you rarely see something small that you need for $10 and it's made in US.
Yeah.
So, and I personally believe that one reason could be because the labor is so expensive.
Mm-hmm.
So if the administration's goal is to bring the production back to the country,
yeah,
does that mean that the labor will be cheaper?
No, it will not be. It will be more expensive.
So
In
then
the US.
How would the production come in?
Energy is cheap in the US. Natural gas is cheap. There's oil production happening in the US. Saudi Arabia is producing less than the US. I'm sure you know about that, right? US is the #1 oil producer on the planet. How is that possible? Because we're drilling and we're producing an insane amount of oil and natural gas, and cheaper than anyone else. And that could be converted into energy. And imagine you have artificial intelligence, robotics, and a bunch of other stuff. Then you can produce more stuff in the US with the labor that you have, in the country. But then you don't have the resources, right? You have to bring materials like copper, iron ore, rare earth metals, right? And that means you have to pay for those. But at the same time, when you look at, all the, electronics is designed in the US, produced in Taiwan, sold outside of the US, and all the, programming is happening in the US, and you're paying some fee, even if you're using outside of the US. US is exporting enormous amount of goods and services. It's not visible Like, when you go to Walmart, everything looks like, it's coming from China or from, Latin America and a bunch of other countries. But when you open your iPhone, all the applications are the US applications, the Microsofts, the, Open AIs and ChatGPTs and a bunch of other stuff. Someone is paying for that. The entire planet is paying for that, right? Because everyone is using that.
How does it reflect on the US dollar that is depreciate right now, right? We can see that it's fallen down, tariffs going up,
and
the price is increasing. So connecting to what you just said.
Show me one country that doesn't happen. So show me one country that depreciation doesn't happen. There are two friends of yours behind you. They're from Turkey. Ask them what's happening to their currency, right?
It is, but comparing to
it's like
comparing to euro.
Yeah, US is the least dirtiest shirt in a laundry basket. What does that mean? Is like, I'm sure you want to go out on a Friday night, you don't have a shirt, you go to your laundry basket, you're like, okay, let me find the least dirty shirt so that I can put on. US is that. Every country on the planet has some issues, right? And US, they have the fair share of issues as well, but again, ginormous economy, it has lots of energy, all the energy it needs, almost all the agriculture it needs, other than avocados, which we definitely need, right? They can produce anything and everything. So it's a very unique country. When you look at all the other ones, maybe Russia has that potential, but it has been using that potential really badly as well. That has energy, agriculture, and smart people and ginormous country. But they fail to compete with the Western economies.
China doesn't have that
because it doesn't have energy. It doesn't have materials as well. It doesn't have lots of commodities. 1.4 billion people, it's a lot. India, on the other hand, it has the agriculture but doesn't have energy as well. Right? India is still buying enormous amount of oil and gas from Russia and from Iran and from a bunch of other countries.
But what if they partner? Like India has
yes, that would be amazing.
Energy.
Yes, that would be amazing. Great for them. I hope they can manage to do that. And that's the reason Russia and India, they agreed that Russia will be selling oil and accepting Indian rupee instead of US dollars. It slowly start happening, and that goes back to the question like what happens to the US dollar in that picture. The value of US dollar in everyone's mind goes down a little bit, of course. Yeah, for sure.
Would that be a threat to the US economy?
It is a little bit around the edges, but then US economy is smart enough to come up with something else, and that something else is artificial intelligence and robotics and electronic vehicles or electric vehicles and a bunch of other things that the US produces. Or new applications on your iPhone, right? Many of them are coming out of the US.
But we can see even on technology, we can see that even China is competing right now with artificial intelligence, like DeepSeek, right?
Yeah.
A great competitor to ChatGPT, right? We can see that it's getting implemented there as well, and we can see the labor on China is competing to the United States.
Yeah.
We see they are like number one in
especially for. I hear you, but especially for ChatGPT and DeepSeek, which one came first?
Of course, ChatGPT.
Yeah. So they kind of, if they see, oh, this is how you do it, I'll do it better. I can understand that. They do it amazingly, and the Germans are, very good as well. They're, very good engineers that they can replicate things pretty, easily. But the first mover advantage in some of these industries is huge. And that's the reason when you look at the software businesses, the Microsofts, the Oracles, the Googles, the Facebooks that I'm talking about, the whole world is using them. Right? There is no competition. Time to time, like TikTok showed up out of nowhere and then grabbed billion users, and we cannot uninstall them in the US. It was almost impossible to do it. So they had to come up with a deal so that Oracle can buy them and control the data in the US versus outside.
Is there a possible scenario where production can start emerging? What would it take?
Again, if you have robotics included with the artificial intelligence, or imagine, all the trucks are autonomous driving. Now you have 100,000 people that you can deploy into manufacturing lines. It's possible. It's doable. We'll see if it's going to happen or not. US has a tremendous potential on that. As long as you have energy and commodities that you can produce in the US without destroying your environment. The biggest discussions that I had this week was related to rare earth metals. I'm sure you have heard about them. China is producing 70% of it. US is producing like 10, 15. Can they produce it here? Yes, but some of them are radioactive. If you produce them here, you're going to create radioactive materials. You're going to destroy your environment. Instead of doing that, US is trying to find friendly countries, like maybe Australia will do it, maybe Ukraine will do it, and that's the reason they're trying to sign these critical mineral deals with those countries, so that the outside of the US will be destroyed in terms of environment versus in the US.
Considering we have it's a finite resource, whatever rare materials that we do have. It's not like it's going to continue to produce.
That's true for everyone. It's not only for the US, but
US be back into a corner where it has to mine its own land.
I mean, rare earths are not that rare anyway, so you can find them almost anywhere. But you have to have a mine, you have to have a processing plant, and you need to use good amount of water to process them as well. Do you want to do it in the US versus in Ukraine? Right now, it looks like they want to do it in Ukraine instead of in the US.
China's strategy was amazing, right, in the last few decades.
Yes, I mean, it started in 1980s, when they were saying like, okay, we have to, produce something that is not produced in the US. And at that time, these rare earth metals only used in these screens, like, big TV screens, the color, screens. And then the magnets showed up. There is one metal, it's called neodymium. Have you heard about it? So this neodymium magnet is unbelievable, and you have to use it in electric vehicles and missiles and F-35s. And if you have an iPhone, the iPhone has like 5 grams of rare earth metals, but when you look at F-35, it has like 920 pounds. Or a destroyer has like almost like 10,000 pounds. So you need enormous amount of production that's happening. Of course, US doesn't have that. And China now says like, okay, you can buy them from us, but you have to apply. And if you have to tell if you're going to use this for civilian purposes, electric vehicle, that's fine. But if you're going to put this into a missile or F-35, we're not going to sell it to you. That's a smart move. And we're supposed to have a meeting at the end of this month between Xi Jinping and Donald Trump. It looks like it's not going to happen. It looks like it's a negotiation tactic, and they're very smart using this tool. We'll see if we're going to have a meeting or not. But the US can produce these metals if they want to. It will take maybe 2-3 years to find the resources from other countries. It's doable, but they have to find some new, places to produce them.
Yeah, they are both great powers, and we need them to agree on key issues, because it affects all our lives at all the emerging markets, everyone in the rest of the planet.
But the good thing is like it may, some, especially the Southeast Asian economies, many of them have better relationships with China, so they can buy from China and then produce whatever we need, and they can send it to us. There's stuff happening, and the best example is look at what happened after the Russian exports. It didn't stop. They were exporting directly to Germany. Right now, that cannot be done. So it goes to Kazakhstan, from Kazakhstan to Germany. And still, Russia produces as many things as they can, and they can export it out pretty easily.
With some discount.
Yeah, it's, of course, someone else is making money out of that.
Any other questions?
Yes,
please.
Just to understand a little bit more, like your point of view, because you're the expert, but I feel like what you're just mentioning is a little bit different from what I heard in my daily life and what's happening in the current situation. And I mean, you mentioned the rent rates are going to go down because people that has different visa types of visa, they're going to leave.
Yeah.
And do you think that's going to also impact the labor market? We were talking about labor market.
Yeah, from a US point of view, to be honest with you, especially now, I mean, I have lots of students at the university and they're looking for jobs and they're having a hard time to find them. So imagine there's less competition for them. And now they have AI as well, so they can apply to certain different jobs as well. So they should be able to find, relatively speaking, easier jobs with some people moving out of the country. That's the plan of the, I guess,
so there are
US thinking.
Labor, other type of jobs that Americans, they don't want to do. And many people are
But
leaving.
those are not the ones that H-1B, visa people do.
The immigration situation. Plus, also there is another word that caught my attention. It was inclusiveness, which is, for in my opinion, it's being attacked in this moment.
Yeah, again, you may have a bad hair day and a good hair day. This period will pass. I have been here since '98. There's some good years, there's some bad years. But eventually, country moves to the, I think, correct direction, which I believe will continue to do that.
With all these situation, and I know you said there is no there is some other type of information that you can get because the government is closed, so you cannot get this information from the labor
Data.
Yeah. Exactly. Because what I understand, maybe it's wrong. It's just I want to understand more. And what I understand, they also they fired the person who was bringing this data about the jobs, many people losing their jobs. So I'm just wondering.
So I mean, you're right to worry about where the direction is. And again, we're studying the data set from just pure data without having any emotions. So when you're watching, TV and reading newspapers and, looking at your Instagram feed, you feel depressed, of course, But if you just look at the data and you're saying, how many people are working? Are they receiving paychecks? Are we creating enough stuff? Are we bringing the things that we need from overseas? Yeah, if the answer is yes, 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 and the economy grows, and we see that in data set. And the question that everyone asking is, okay, now AI is coming and there will be fewer jobs for fresh graduates. What can you do? Imagine you're a US person, what can you do? That means you have to limit people going into the country grabbing these low-level jobs, or the beginner jobs, right? And I think that's what the administration is doing. They're limiting how many people are coming into the country and grabbing those entry-level jobs. So they're saying if you're super smart, let's say you're an amazing analyst and the company is ready to pay $100,000 extra to employ you, they're saying fine, we'll let that person in. Not an entry-level analyst that's coming from overseas and grabbing jobs in the US.
So do you think the economy is not being affected by not this type of visas, the H-1B, but the other type of visas or other people that is maybe with no?
Yeah, no, it will be affected for sure. But at the same time, high interest rates in the US, that's affecting the economy too. So imagine, inflation is coming down with energy, with rents coming down. So that means the yield curve, the stuff that he mentioned, comes down in the US. That benefits everyone in the society. Like 350 million people, every single person is borrowing. Credit cards, auto loans, mortgages, all the commercial loans that you do, that benefits everyone. So that's a huge plus when you do that. And this is the moment in time you kind of have to do it because we had a high inflation problem in the US.
I think we have to stop here.
Yeah.
Thank you very much, Eylem. You have given us a lot to think about. At least on my side, I'm more optimistic about US.
Yeah, no, be optimistic. And again, I said so many things, and don't try to remember anything that I said. But the only thing that I would recommend is that $5, story. You wake up every morning, put $5 into the market, and you just close your eyes, and eventually it's better. This is what I do for my kids. I have 529 accounts for my kids. I have 2 kids. 529 is the savings account for universities. So let's say I'm putting, I don't know, $10 every month. And on the 25th of the month, I look at the market. If the market is down, I send $20 instead of 10. So double up. Those are the best days to buy. And eventually, the market figures this out, and how many people needs to work on certain things, AI or without AI, and what type of materials that we need from which country. Market makes it happen pretty quickly, surprisingly. It's one of the most efficient ways of deploying capital is in the US. Versus China has been doing pretty good as well because it's a government-controlled entity and they can control certain things. But when the market controls everything, it's a little bit better than the government control. And it looks like the data is definitely saying that, or translating into higher numbers, which is great. Be optimistic. Don't you can easily scare people, but staying on the optimist side is much more profitable at the end.
Yeah, his story is getting faster and faster, and we hope to see you again.
Great.
We will be very happy to host you again, and we truly appreciate your time.
Awesome. Yeah,
and
thank you for your time.
Thank you so much.
Okay, thank you. I hope I answered all your questions, and I'll stay here for a couple more minutes if you have questions. We can go one-on-one as well. I hope that was useful. Okay, great. Thanks.
Thank you.
Yes. So as a national economics class, have you all seen the paper?
Yes.
Yeah, mine.
Evet.